Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, 30th May 2025, and joining Derek to pose some questions on the financial market themes for the week ahead is Shan Husain from Institutional FX Sales EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Welcome, Derek.
Hi, Shan. How are you?
I'm good, and welcome to our listeners. Let's dive straight in. There's been so much going on. The obvious place to start is obviously Trump and his trade policies.
Well, it has to be, doesn't it?
Yes, it does, and he does try and target Fridays for his announcement. So obviously we had the China announcement, and I'd like to hear your thoughts on that, and also generally around the uncertainty, because in the US, obviously with the court order and how things are shaping over there, what are the sort of pitfalls and uncertainties that we currently have to navigate? Could you please share your thoughts on them?
Yeah, I guess that gets to the heart of, I think, why the dollar has probably retraced the strength that we had initially. That point about what are the implications in terms of, uncertainty. And I think the initial response when we had the Court of Appeal decision was, this is good for the dollar and it's going to impact Trump's ability to implement his trade policies. So we had a bounce in the dollar, but of course, there wasn't a whole lot of logic in that. We've already seen, of course, the Court of International Trade was the initial announcement, of course, and then we've had the Court of Appeal come back and give a stay on the tariffs remaining in place. So, but even before that, the dollar was beginning to retrace because, take it either way, the appeal is unsuccessful, and the Court of International Trade's initial ruling holds. Well, Trump's just going to look at other avenues, and there are plenty of other trade acts and sections that he could look at. He could become more active in terms of sector specific and go across a wider array of sectors on particular countries. And that could become, obviously not as impactful as a broad-based reciprocal tariff of 10% across the world, but he could still cause considerable disruption. And then, of course, the process of this Court of Appeal decision could be some time. And, you would never bet against the Supreme Court ultimately coming back in favor of Trump. So all in, as we sit here on Friday afternoon, if anything, you would argue that we have increased uncertainty compared to where we were before, because at least with the reciprocal tariff plan, we had levels, we had dates in which they would be implemented. We knew that trade deals were being negotiated, and that would mean maybe the tariff reciprocal rate going back to 10%. So there was a kind of a clarity in the plan, even though it was ridiculous in terms of the tariff rates in some of the countries. But now it's kind of all up in the air in terms of potentially what the approach could be going forward. So I'm not surprised the dollar has retraced its initial strength. And really, we're still in that kind of uncertain environment. And then, of course, as you've referred to in your initial common question, he's come out pretty aggressively complaining about China and the fact that they haven't stuck to the deal that was announced in Geneva on the 12th of May. So, yeah, what does that mean? I don't know if you saw, Shan, that question from a journalist about Taco, referring to him being a chicken and always chickening out. And, we all know Trump didn't like that question. So if he wants to kind of emphasize that he's not a chicken, maybe we should be bracing ourselves for, some increased aggression over the coming days. And maybe this kind of complaint about China is a signal of something to happen. So yeah, elevated uncertainty doesn't do anything for confidence in US assets. That whole theme remains in play, I think. And question marks over US exceptionalism are not going to go away. And I would imagine that's a theme certainly through the rest of this year and perhaps over a longer period than that.
Thank you, Derek. Yeah, thanks for your response over here. And yeah, I did listen to that chicken comment. Moving on to Lagarde's speech on euro reserve currency status, and we have the ECB meeting coming up. So, could you please enlighten us and shed some light on what we can expect here?
Yeah, well, I go back to like Monday when it was a holiday in the UK, but Lagarde gave a speech in Berlin and focused very much on the potential for the euro to take on greater reserve currency status. And she essentially described current period as a window of opportunity for Europe to create the conditions for the euro taking on a greater role. Now, some of that can be done obviously by Trump in terms of a move away from the US dollar. But as Lagarde said in her speech, it's not going to fall on Europe's lap in terms of increasing the reserve currency status role. Europe needs to take steps for that to become a bigger feature going forward. So going back to the Draghi competitiveness report and creating conditions for improving competitiveness, reducing barriers to trade across the single market in both goods and maybe more importantly in services, and taking steps more towards a unified capital markets. There's progress that is being made, and I think definitely more can be made, especially if some of the measures from the Draghi report are embraced. It's all kind of medium to long term stuff, but I do think it was an interesting speech from Lagarde in the context of next week, because she's going to be asked about the dollar and question marks over its confidence in US assets. So I'm sure she's going to repeat some of the comments that she made on Monday. Ultimately, what does that mean for the markets? What's the signal to the markets? Well, for me, the signal is we embrace euro appreciation. If reserve managers are coming into Europe, it's a sign of confidence. A stronger euro helps to keep longer term yields in check because it's disinflationary. So ultimately, it's a supportive feature for domestic demand. And if we can't rely on external demand because of the global uncertainties in relation to trade, it's better to shift the focus to domestic demand. And in that context, a stronger euro should be embraced. And I think ultimately, if she's asked about that, which I think she will be next week, I would imagine her comments will be quite supportive in terms of taking on a greater role in becoming a bigger kind of reserve currency. Like composition in FX reserves globally, according to the IMF, is around 20%. The peak before the global financial crisis was 28%. So even, without any dramatic changes to the construct of the single market, we can at least assume that there's scope there for a retracement back higher, and then potentially beyond even higher if Europe takes steps. So yeah, I think that could become an interesting feature. And flow data does indicate that foreign investors are coming back into Europe. So the removal of negative rates is a really important step in terms of reserve currency importance. And without negative rates, I think the impediment for reserve managers coming into Europe is gone, and that should certainly help over time.
Thank you. Yeah, we'll keep our eyes on that meeting and let's see what happens. All right. So the final question for today would be around Japan, the BOJ and JGB sort of risks ahead. Obviously, we had the disappointing auction earlier. So could you please try and give some context here on what the risks ahead are?
Yeah, like I think this is part of a global thing, first of all. Like obviously we had the move higher in US yields, we had the Moody's downgrade, we have this huge tax cutting bill going through Congress. So, correlations between JGB yields and US Treasury yields they're not massively strong, but they're still significant enough. So there's definitely that influence at play. Then, of course, the BOJ at the end of March announced its monthly buying purchase plan for Q2, and they cut their super long purchases from 450 billion per month to 405. So I think that although that announcement was end of March, over April, May, it started to have an impact, because when you look at the flow data for super long JGBs, so over a 10-year maturity, what you can see in the Tokyo Securities dealers flow data is that Japanese lifers, for example, in the 3 months to the end of April, which is the latest data that we have, were record sellers of super long JGBs. Japanese banks were record sellers of super long JGBs over a 3-month period. And then foreign investors were record buyers of super long JGBs. And then if you look at the weekly data from the MOF, what we've seen is that foreign investors have turned from big buyers to sellers. Now, in the weekly data, we don't know the tenors, but we can, I think, reasonably assume that it probably includes super longs as well. So in other words, the shoot higher in long-term yields in May, in part, could be the fact that foreigners have stepped away from supporting the markets. Now, the question now is, when do Japanese banks come back? When do Japanese life insurance companies come back? And obviously at higher yields, at some point we're going to get an equilibrium where we'll start to see better supply demand. But, the risks are there. And I think from an FX perspective, I don't buy the idea that fiscal concerns are going to come back and we're going to start getting into negative implications from an FX perspective purely based on the fiscal situation. And partly, by the way, why this was triggered was a speculation about another fiscal stimulus plan by the government. But Prime Minister Shiba has shot that down. So I don't think that's going to happen. Certainly not one that's financed by additional JGB supply. So I don't think that risk will emerge. But, ultimately, where there could be an FX influence is that if the BOJ consider their hawkish communications, if you like, certainly signaling that they could hike rates again, does JGB disruption and disorderly price action, does it force the BOJ to become more balanced in its communication and maybe, or you could say even more dovish? Now, I don't think, again, that happens. In actual fact, you could argue the opposite, that they'll be encouraged to stay hawkish because obviously they want the yen to be stronger. A stronger yen helps to counter domestic inflation, which in theory is supportive for long-term yields. So, but some argue the other way, that because there's a premium of hikes at the front end of the curve, that is in part embedded into longer-term rates. But ultimately, I think an important feature going forward will be to avoid any kind of sustained renewed yen selling, because I think that would be disruptive to long-term JGB yields in terms of pushing them higher. So to me, it still argues for the yen to strengthen going forward, and listeners will know that's our view. We still have a short dollar yen position. And I just think broader conditions in Japan, we had high inflation figures today out of Tokyo. It's all still supportive of the yen strengthening going forward.
Thank you, Derek. And thank you to our listeners. All the best ahead. And no cold turkey for anyone.
Thanks, Shan. Have a good weekend.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Join us again next week for more expert insights from our global markets research team.